we have a great opportunity here in front of us, and it's almost incredible that it still remains so unexplored or underappreciated. And if I really can only get 2 points across here today, it would be the following. Number one, that there is this attractive opportunity for private equity in emerging markets for investors from a risk-adjusted returns perspective. And then two, that this private equity capital is actually crucial in creating lasting positive impact in these countries and communities. So we have this almost unique opportunity that doesn't happen a lot, of two positive and promising things at once. Potential for attractive risk-adjusted returns for investors and a potential for strong impact. And I actually think that they go hand in hand in a very synergistic way. So when we think about emerging markets, maybe let's just briefly define that. So that's previously called developing countries, everything that is not a developed market, such as United States or Western Europe, and it typically includes countries such as India, Vietnam, Ghana, and South American countries, Sub-Saharan African countries. The key issue in these countries is access to capital. Too little capital is flowing into these emerging markets or frontier countries, especially in the private equity side. And I will talk a little bit about why particularly private equity is important. Over 90% of the world's young population lives in emerging markets. But these countries only receive a small fraction of the global private capital. So it's severely underinvested. So you have a couple billion people, and that even excludes China, who are joining in the middle class who demand simple services that we take for granted, such as healthcare, education, manufacturing, industrial distribution. And there are a lot of companies out there and entrepreneurs and founders that can be key catalysts for growth and create entire markets and innovators that are just starved for this growth capital to actually bring all these companies to their potential and create these ecosystems of markets. And we can talk a little bit about impact itself and the label of impact investors. I think in the grand scheme of things, it's not even about impact or non-impact investing. It's primarily about getting capital to these countries.
Thank you. Well, I'm going to, as I mentioned, I'm going to start with a question or two. Now, as we move into the core of the discussion, I'll say again that when you're called on before proceeding with your question, you're welcome to share your own reflections on the topic. If you do, we ask for your consideration for others with questions in the queue, and keep your comments and questions as concise as possible. If I feel that you're taking a bit too long, I will gently ask that you finish up and get to your question. There is no offense meant by it. I'm just trying to keep the proceedings moving along and letting as many voices be heard as possible. So again, please raise your hand that's in the reactions tab at the bottom of your Zoom box. Or if you're not comfortable speaking your question, write it into the chat. Clemens, your article that you wrote for us provides, and you've also touched on some of this briefly in your introductory comments, but your article provides a number of examples of private equity investments that have led to significant societal benefits. And I'm wondering, can you share more about the process of identifying and executing such impactful investments?
Yeah, of course. I mean, maybe it's helpful to just briefly state why private equity specifically and growth equity in particular is the right way to do this, because we just discussed about how important it is to just simply get capital to these countries and markets. So why not public markets or venture capital or debt or philanthropy? So first of all, most companies in emerging markets are too small or just not of the scale to attract debt or be publicly listed. They're still in the early stages of their growth. And philanthropy is helpful and is very good, but it's not enough. It's less than 1% of the capital available compared to commercial capital. So commercial capital is really needed as a catalyst for these things because philanthropy is just not enough. And versus venture capital is very interesting and there's a lot of potential there. But generally, there's a lot of venture capital already flowing in these emerging markets countries. So when you look at the capital raised and invested over the last few years, you can really see the spike, the ballooning of venture capital flowing there. And it's generally smaller check sizes, less of 10 million, where there's a lot more liquidity in these countries. But growth capital is really where these countries are particularly lacking. So growth capital is typically companies that are growing out of the venture phase, that are already on the verge of profitability. And need to scale beyond that and need larger check sizes, typically of 10, 20 million and above. And that's specifically what is missing in a lot of these countries. And private equity can also be impactful in a way that investors have more positive influence on a company. Active investors can push for more sustainable practices or for value-added initiatives. So when it comes to identifying in kind of a process these opportunities, I think what is really important is to be a fundamental growth equity investor. And that means being distinct from a venture investor. Again, in emerging markets, venture is becoming more competitive, but growth is particularly lacking. So there's often a tendency of venture investors to write just larger checks. And I think what is really needed is a fundamental approach to investing. That means not just trend following, not investing in trendy businesses that have potential and making thematic bets, but actually fundamentally looking at a company, understanding the operations, understanding their accounting, analyzing their financial track record, properly valuing the future potential, reviewing the second layer of management, all of these kind of operational things, like how are they accounting for working capital, that you often don't do as a venture investor, maybe sometimes because you just simply don't have the information given the stage of the company. And it also includes planning for a proper exit. When you're a venture investor, you often rely on getting liquidity in future funding rounds. When you're a growth equity investor, you can't rely on that. You actually have to have a proper exit, and that often means either pre-planning an IPO or another exit, or actually structuring your investment in a way that provides you with an exit. So those are all the kind of things you have to think about when you are a growth equity investor. Mm-hmm. And I think additionally, and we can talk a little bit about impact and specifically, but I think there might often be a misunderstanding, and I think that is particularly true in emerging markets, of a trade-off between impact and returns. And it's particularly striking in emerging markets where the impact returns are so much lower than the non-impact returns. In developed markets, when we look at impact and non-impact, the returns are almost the same, kind of proving that there shouldn't be a trade-off between impact and returns. Both can be achieved at the same time. And when you look at the work that development finance institutions in emerging markets do on a daily basis, such as IFC and others, I think they're showing on a daily basis how value additive a thoughtful impact strategy can be and should actually not distract from returns. So when it comes to analyzing these companies and identifying the processes, I think those are two key critical things: is one, proper fundamental investing, planning for proper exits, and then also having the right impact approach that doesn't actually distract from the returns.